Well, I think all the businesses that we have are operating well. I think we've got a good momentum, and it hasn't been an easy year. There's been some pretty rough and rocky moments, and our result would have been better had it not been for our trading income being slightly down because of the disruption in global markets. During the last few months.
How do you see the current Australian economic environment?
Look, I'm pretty optimistic about the big picture. When you look at the Australian economy, there is no doubt it's multi-speed. I don't think you could say that things are going well for everyone, but that's actually normal. I think if you look at the resources sector, that's going extremely well. And everything that has to do with that sector in terms of the supply and indeed the services sector around that is going very, very well. Other areas, of course, traditional manufacturing and low-value items are struggling because the strong Aussie dollar is obviously playing a part there, although of course, interest rates, are relatively low.
So do you think the Reserve Bank decision to cut rates was justified?
Well, I think that if you read the review or read the draft release the release from the Reserve Bank, basically the reason given is the global uncertainty, basically because of the situation in Europe and how that unfolds. I think that is still very uncertain. So I can understand that concern. The inflation pressure has gone away, really because of the strong Aussie dollar. That's taken all that problem away and has done the heavy lifting for them. And I think psychologically there probably needed to be a little switch, and I guess that's what it is. I mean, a 25 basis point reduction in rates is not going to have a massive stimulus effect, is it? But it does have a confidence effect. It does have a sort of psychological effect that rates are beginning to go down.
Is that why you decided to pass on the rates in full?
Yeah, I mean, I felt that there is no doubt that there are elements of the economy which are still struggling a bit. There are people doing it tough, and I felt it was the right thing to do this time.
NAB hasn't passed on the rate cuts in full, they say, because of an increase in financing costs. Is that argument valid?
Yeah, it is. I mean, costs across the board have gone up. But I think you have to consider where they were in terms of their positioning. They were very low cost. How sustainable was that to maintain?
But do you think it's perhaps an indication that the breakup campaign was a bit shallow?
Well, it's nice to have them back. What can I say?
You've talked about a difficult trading environment, economic volatility, caution and higher funding costs. How has all of that affected the business? I think business confidence generally has been a little uncertain. Instability of any type always creates a degree of uncertainty, and I think that we have been in highly uncertain times. And most of it has been generated, most of that instability and uncertainty has been generated by Europe. But especially in relation to the health of banks, are you concerned that perhaps a fresh round of regulation might have some unintended consequences?
Yes, I mean, I'm certainly concerned about some of the regulatory constraints that the banking system is being saddled with globally. I think. Look, I can quite understand that there was a need for regulators to look at regulation and to determine, what was appropriate and what could be done to prevent another global financial crisis. Quite clearly, I understand that rationale. But what has happened is that a lot of this regulation has been sort of hijacked for political purposes. And the speed of some of its implementation, I don't think has probably been thought through, because why would you impose massive increases in capital in banks that are really struggling, and I'm talking Europe here,
at a time when the economy is in a very, very fragile state, why put further pressure on a global economy which is really, as I say, really struggling to get out of this mess? So why not wait a little?
What about in Australia? How do you see this regulation implementation affecting us here?
Well, I think the issue here is that we're imposing these standards, particularly through the Basel III standards, ahead of anybody else. And I mean, the regulator here would argue, well, that's good because it shows that Australia can do that, and that the banking system is strong enough and is able to accept these new standards, and I get all that. But it does mean that you are then globally uncompetitive, because if you've got to hold more capital or hold more liquidity than your global peers, it must mean that you're globally uncompetitive. It's harder to do business because they can do business at a cheaper rate than you can.
But relatively speaking, the Basel III reforms, as interpreted by APRA, won't require the Australian banks to take anywhere near as much action as they would the European banks, simply because of their position. And commentators have said that Australian banks are in a very good position to meet those challenges.
Yeah, but I'm saying, why? So if that's the case, what's the big panic? Why do we need to hurry to do it? Because, as I say, at the moment, it does put us as a disadvantage in the global marketplace.
You've seen some pretty significant declines in the global markets business. Is that something to be concerned about?
No, not really. I mean, that was really it's the fixed income side of the trading business of the Aussie dollar book, and we highlighted this in our trading update in August, and that was purely a result of the global conditions. That is actually, I think the issue there is that we've always been too dependent on that business. And if you look at our results over the last sort of 5 years or so, they have been stellar performers over the last 5 years. So there's inevitably a time when it's not going to be as good. Now, what we've been doing is actually building up our capability in foreign exchange and commodities, but also in sales. And we needed to reduce our dependence on trading, and we've actually been making good progress in that. But it's still an important element of income we earn, and our bank has a larger business. We have a larger institutional business than the other trading banks. That's why it's more noticeable.
You've said before that part of the reason for that decline was the decision by the bank to be somewhat risk averse. Do you think now, looking back, that you made the right decision there?
We definitely took a risk-off approach during that crazy crisis. It was a few weeks where the world just went mad. And I felt at the time that it was so unpredictable, it was so difficult to read, that we should run a risk-off position, which is what we did. We've now gone back to a normal trading environment. That is within the bank. I mean, I think that the world is still a pretty volatile place. But I think it was the right decision. It means that we didn't make as much money, but we didn't lose any money. That's the call. And I think that that's a prudent call in the situation.
Are you worried we might see similar declines in the coming year?
Well, I hope not. We've started off the year pretty well, so hopefully that will continue.
Do you see, to some extent, the current global uncertainty as validation of your strategy regarding Asian expansion?
Yeah, I think so. I mean, if you look at the growth areas in the world, there are probably only three. One is Asia. And that's quite clearly the biggest growth engine, driven basically by China and India. The second is Latin America, which is fundamentally driven by Brazil, but of course is much smaller than Asia Pacific. And the third is Russia, Eastern Europe. Those are going to be the main engines of growth for some time. And Asia Pacific is by far the most significant and the most important of those. So absolutely.
Do you see opportunities there in the Asian business from all of that uncertainty in Europe?
Yeah, I hope so. I think we'll see a few opportunities. Look, these banks will have to sell down some of their assets. They may have to sell businesses, or they may have to sell portfolios, but also they're going to have to contract their balance sheets because they don't have the capital to support growth. So that means we'll have a playing field with very few players on the opposition, which is always nice to have.
Moving on, one thing that you've consistently mentioned, and you also mentioned it last year, was an increased focus on productivity. But costs are up across the board.
Well, I mean, we have a model which is high income, high cost, which is different to some of the other banks. I.e., we invest as much as we can afford in terms of to meet our strategy, and that really is driving the Asian expansion and the institutional bank. So our cost base is always going to be higher than the other banks. The issue is that we should always have the income to pay for it, and because we had a slowdown in income, particularly from trading income in the second half, we really did constrain costs as well. So our cost growth in the second half was 2%, which is not, you would not say is wildly out of line.
What specific productivity enhancing measures are you taking?
Well, I guess that our most important, I think the most important part of our model is the operation centres that we have in Bangalore and Manila and Chengdu. I actually call them the centres of excellence because they are very significant operations in themselves, and they allow us a flexibility to actually build volume or actually control cost in a way that if you have it in hundreds of different centres, it's much more difficult.
In the global markets business, though, you had nearly a 30% decline in profits and costs were still up. Does that perhaps point to some problems with flexibility there?
No, I mean, I think that was an income problem, not a cost problem, as I mentioned earlier. But I also I think it's also important to realise that the cost increase there is as much an amortization of new systems that we've put in, for the future, and new people. So it's something that we'll watch, but I'm not too concerned by that.
You've seen some significant growth across the Asian businesses in the past year. Is this coming year just going to be about a solidification of those franchises? What are you hoping to see there?
Further growth. No, I think we're going to have a very interesting year. I think because we're going to see the competitive environment in Asia change so much because of the problems in Europe and the US, I think we're actually going to have quite a significant opportunity, much like we had in 2008. And I think that I think we've got to a tipping point where we've really got a credible business there, and it's really moving well. And next year, I think we should start to really reap the rewards of that. Sincerely hope so.
And what are your expectations for the Australian economic environment? How do you see yourself placed in comparison with the other major banks?
I think we're pretty well placed. I think we've done a fairly sensible or had a fairly sensible strategy around our retail business. We didn't want to go head to head in a massive price war. We have maintained our market share in mortgages. We grew at 1.2 times system. I was very, very keen on growing our deposit base, and we've grown that at 1.5 times system. So, I think we've done a good job in that. I think we still have a huge potential in a commercial bank. I still think that is a franchise that we really have yet to rev up. So I think that there's really significant upside there. And I think our wealth management business is a bit disappointing. It hasn't done as well as I'd hoped it would by now. But again, I see that as an upside opportunity.
Fantastic. Thank you so much for your time.
That was great to see you.